Welcome to Casense.
Imagine an exciting young tech company. From the outside, their sales are going straight up. But behind closed doors, they are burning through cash so quickly that they might not survive the year. How can you tell if a business growing this fast is actually healthy, or if it's heading for a crash? To figure this out in seconds, investors use a simple health check called the Rule of 40. It lets you see if a company is balancing its rapid growth with financial discipline. Here is the entire rule. You take a company's revenue growth rate, add its profit margin, and see if the two numbers add up to at least 40%. Think of it like a seesaw. On one side is growth, which measures how fast sales are rising. On the other side is margin, which measures how efficiently the company turns those sales into actual profit. A young startup might be focusing heavily on expansion, scoring a 35% growth rate with just a 5% profit margin. An older, more established company might flip that entirely, with 5% growth and a 35% margin. Both equal 40. Both pass the test. Investors rely on this rule because it rewards overall balance. A company cannot hide a completely broken business model behind one incredibly flashy sales number. Let's look at how this works in practice with a company we'll call TaskNest. They make project management software that customers subscribe to every month. And while their sales are climbing, they are spending investor money constantly. Their lead investor wants to know the truth. Are they actually building a sustainable business? To answer that, we apply the Rule of 40. Step 1 is measuring the growth. This calculation shows the money TaskNest collected from its regular monthly subscribers over the past year. That total grew from 8 crore to 11 crore. Doing the math, we get a revenue growth rate of 37.5%. On paper, this makes the company look highly successful. But step 2 is measuring the margin. That's the money left over after paying for the daily costs of running the company. This calculation shows that to bring in that 11 crore, TaskNest actually spent 1.1 crore more than they made. That means they have a profit margin of negative 10%. Step 3 is the final verdict. We take the 37.5% growth and add the negative 10% margin. That gives us a final score of 27.5%, well below the target of 40. TaskNest fails the test. That one quick sum reveals that their exciting growth is being bought with heavy, unsustainable losses. Once you have a failing score, the solution isn't to spend even more money trying to force sales higher. The solution is to fix the margin. TaskNest decides to adjust their strategy. They stop offering aggressive discounts to new customers, and they cut 2 costly software tools their team rarely uses, making their operations much more efficient. Fast forward 1 year, and we check the numbers again. TaskNest's growth slowed down slightly to 32%, but their margin jumped to a positive 9%. We calculate the new total. 32% plus 9% equals exactly 41%, putting them securely into the healthy zone. The founders realized something important. To save their business, they didn't need to capture more of the market. They just needed to grow profitably. In the real world, the Rule of 40 is a specialized tool. If you use it in the wrong situation, it will lead you to the wrong conclusions. It works best for evaluating subscription software businesses quickly, or as a fast screening test for investors sorting through dozens of startups. But you shouldn't apply it everywhere. Avoid using this for brand new startups that don't have stable revenue yet, or for traditional businesses like factories and retail stores, which have completely different costs. To keep this analysis honest, we have to be careful with the numbers we choose. We should look at predictable money from subscriptions, rather than one-time sales spikes that make growth look artificially high. We also need to watch out for extreme cases that can trick the math. This chart shows a massive spike in revenue growth next to a deep negative profit margin. A company could have 100% growth alongside a devastating negative 60% margin. Mathematically, that equals 40, but this business is actually in deep trouble. That's why the Rule of 40 is meant to be a screening tool to help you figure out what questions to ask. It is never a final instruction to blindly invest your money. By making us look at both growth and efficiency at the same time, this simple math prevents us from being blinded by flashy sales numbers. Instead, it forces us to step back and look at the whole balanced picture of a company's health.